Hello and welcome everyone to this webinar on systematic investment plan. I think all of us, as we wake up in the morning and read the economic newspapers, the news is grim. Stock markets are falling, real estate isn't going anywhere, except for the fact that gold seems to be doing rather well. Clearly, there is a sense of the country itself not doing very well, and clearly the stock markets are reflecting that. The Indian rupee is reflecting that it is sinking to new lows almost every day. In such a situation, I think a lot of you probably do investments in systematically through a systematic investment plan in an equity mutual fund. Most people wonder, what should you do? Markets are down. What should you do? I think that is what this webinar is all about, to address those questions. We'll quickly do just a bit of logistics. If you have any questions at any time during this webinar, you can raise your hand. There is this button there which you can use. I will see it and I will unmute you so that you can ask your question on the mic if you have a mic, and if you wish to type in your question, you can type in your question and I will answer that. You can do that at any time during the webinar and I will try and incorporate that in my answers. So let's get cracking. But before we start, let me do this poll. Let me find out how many of you are investing in equity mutual funds through the systematic investment plan route. So please answer this poll which is there on your screens right now. Please answer this poll. How many of you invest in equity mutual funds through the systematic investment plan? I'm sorry, I gave the wrong poll. Please see this poll. How many of you invest in equity mutual funds through systematic investment plan? I think, okay, this is everyone. So everyone who's here. Oh, that's no. Okay. Okay. Okay, so 90% of you are using the systematic investment plan to invest in equity mutual funds. Let me ask another question. What is the tenure for which, tenure for how long do you plan to continue your SIP? That poll will be on your screens in a minute. Please give me a minute while I put this poll on your screen. What was the SIP tenure that you planned initially when you started these SIPs? What was the tenure? This is the poll that is there on your screens right now. Please answer. I'm waiting for answers. Okay, okay, we are having. Okay, so about 72% of the people really are doing it for less than 10 years, and about 27-28% are planning a systematic investment plan for a tenure of more than 10 years. I think this will become clear why this is important. Let's just go back a little bit. I think all of you will be able to answer this question. How many of you know a proven way to make money in the stock markets? I am expecting answers here. You can use your mics or raise your hand, and I will unmute you, or please answer this question. How many of you know a proven way to make money in the stock markets? Would anybody want to answer that? Does anybody? I am awaiting answers from you. Okay, Vivek, I have unmuted you. Vivek wants to ask this. Vivek, I have unmuted you. Please go ahead. Tell me a proven way to make money in the stock markets.
Sir, we think mutual fund is the only way.
Right. Go ahead, Vivek.
Because I mean, retail investor like me, I mean, I'm not able to time the market.
Right.
So I just, select funds which are in equities and just continuously in that particular.
So what you're saying is that you don't invest directly, you invest through mutual funds, and you invest for a long time, long period.
Exactly, sir.
Okay. So that's absolutely right. I think long-term investments is one way to make money in the stock markets, and data proves it. And if you take the Nifty as a surrogate for the stock markets, here is what data shows. Any 3 years, so we've done this is on the Nifty. So just assume that Nifty is a single script on the stock markets. And this is the data that is represented from January 1, 1995 to 1st August 2013. Any 3-year period if you picked up, if you bought a share and held it for 3 years, your minimum return, you would have had a loss of about 15%. You could have had a maximum gain of about 57%, but on an average you would have made about 12%. Moment you did 5 years, your worst performance would probably have been, not probably, as per the data would have been 5%, your best performance would have been 44%, and your average would have been slightly higher at 12.73%, and so on. In 6 years, your chances of loss reduce, but your chances of max gain also reduce, though the average goes up. All the way to 10 years, you can see that your minimum return, any 10-year period, you bought Nifty at any time between 1st January 95 and 1st August 2003, because you need to hold it for 10 years. At any time if you bought it and you held that Nifty for 10 years, your minimum return would have been 6%, even in this down market. Your max return would have been 20, and an average you would have made about roughly 15%. Clearly, I think this shows that the longer the period you hold the shares, your chances of loss clearly reduce. Obviously, the maximum return you make also comes down, but your average return clearly goes up. So the longer you hold these shares, the better it is if Nifty is relevant and if we treat Nifty as the benchmark for the market. As Vivek said, investing long term through SIP is even better. So you don't have to time the market. Okay. This is what the data shows. Nifty SIP returns between this period. So if you take any 3-year SIP, suppose I started this SIP on 1st January 95 and redeemed it. So 1st January 95, 1st February 95, 1st March 95. I did all that and I redeemed this money on 1st January 98. The second series would have started in Feb 95 and ended in Jan 98 and so on. I would have had about 187 3-year SIPs. The minimum return would have been 23, a loss, maximum of 52, an average of 13.23, the same thing, except that this is much lower. Clearly, when you don't time the market, instead of doing investment one shot and disinvesting at one shot, if you do systematic investment, these figures clearly are less as compared to the long-term holding that we see. In 10 years, you getting 9% as the minimum return versus the 6% that we had. You getting 17% as the average return versus the 14% that we had. You have 27.2 versus a slightly higher figure. So clearly, when you do it through a systematic investment plan, your return is more steady, the chances of loss are lower, and your average return is far, far higher. So I think we're just establishing the fact that a systematic investment plan reduces the risk and for a sufficiently long period, very, very clearly. And I think that long period, as we have seen, is essentially 10 years. If you really don't want the risk of a loss, and if you go by what history says, that you would not have made a loss if you had done a SIP in a Nifty for at least 10 years at any time between 95 and 2013. I just want to check, is this part clear? We have some questions. Rohit has some questions. Kapil has some questions. Yes, Kapil. I have unmuted you.
Hello.
Yes, Kapil, go ahead.
No, I was only mentioning that long-term SIP could be a good option, like you had asked earlier.
Right.
That is all. I didn't ask any question as of now.
Okay. Rohit has some questions. Rohit, would you like to ask your question? Rohit? Okay. I don't see the questions here. No foolproof way, you choose different poll. Okay, I think these are some of the answers to what I had asked. Thank you. So let's move ahead. Clearly, I think those of you who probably started your SIP 4 years ago in an equity mutual fund, even in a good equity mutual fund, wouldn't have had a positive return, probably a slightly negative return. Markets are down. So should you bail out? When the markets are down, should you stop your SIP? Let me ask this question. What do you people do? When markets are down, do you stop your SIP? What exactly do you do? Please do answer this poll before we look at the conclusions. Please answer this poll that's there on your screens. The question was that when markets are down, should you stop and should you remove your money? You have 3 choices. You can remove your money. You can stop your SIP, not make fresh investments. You not only, the second option is you not only stop making fresh investment, you also redeem the money that you have already invested. Third is you continue to make this SIP as if nothing has happened. Please answer the questions. I'm awaiting people to answer the questions, to answer this poll. Okay, I think this poll was shared earlier. So clearly, I think most of you are saying that you will continue with the SIP, and I think that is probably a great thing, as we will see. We have seen markets ups and downs. We have seen them in the past. What would have happened if you had stopped your SIPs during the bear markets? And let's look at these two big bear markets that we have seen in the last 13 years, the period between March 2000 to November 2003, when the markets went down dramatically, and it recovered sometime in the end of 2003. During that period, it was in a prolonged bear phase, and this period between Feb of 2010 and May of 2008 and May of 2010. So let's look at what happened. Let's see how it affected returns. And we just look at the 10-year SIP data. If you remember, if you just continued the 10-year SIP, your returns would obviously be the same. About 9% minimum, 17% average, 27% maximum. But if during those two periods, the two bear periods, if you had stopped your SIP, not redeemed them, if you had just stopped your SIPs, your return comes down by close to 2%. Your average return would have dropped to by 2%. Your minimum return would have in fact dropped by 4.5%. Maximum return would have also dropped by about 2.5%. So clearly, I think if you stop SIPs during the time when the market is not doing well, you are destroying wealth. As somebody remarked, George Santayana, who's a famous essayist and philosopher, those who forget history are condemned to repeat it. The data shows us history on the Nifty. As long as you planned your SIP period well, and I think that is one of the issues in the things that we have seen so far, because SIPs below 10 years do have the chances of a loss. But as long as you have planned your SIP period well, please continue it during any downfall. Your wealth is being created. So as long as your goal is a little far away, a down period is welcome actually, because it is during that time that your wealth is being created. SIP works by rupee cost averaging. So clearly when the markets are down, you're getting more units for the same amount of money, and that's when your returns are being calculated. Let me take some questions now. Where are the questions? Okay, there are questions here from Navneet. Yes, Navneet, I have unmuted you. Would you want to ask the question now? Navneet, can you hear me? Fair enough. Vivek has raised his hand. Vivek, please ask your question. Go ahead.
Yeah, sir. So we have question like, we have read somewhere on the forum that in long terms, so mid caps are giving a higher return than large caps. So is it valid?
Well, right now I don't have data to support that point. So I won't be. We do have data in the back. I don't remember the results, but conceptually, in any investment, higher the risk, higher the reward. And clearly, mid cap and small caps represent higher risk and therefore logically should give higher rewards in a long-term SIP. We will have to look at the data, but in any case, never put all your eggs in one basket, Vivek. So you must, when you invest, you must have a balance of large cap, a portfolio made of large caps primarily, and you can invest small amounts in mid caps and small caps. Don't invest all your money in mid caps and small caps, because yes, the rewards could be larger, but then so are the risks. Sachin has a question. I have unmuted Sachin. Yes, Sachin, go ahead, ask your question.
Hello. Hello, sir.
Yes, Sachin.
Hello, Harsh. Sir, you were previously in your webinar, it clearly shows that invest for a long-term period, for more than 10-year period, right, sir?
Right.
Sir, my question is, actually I want to invest for a period of 7 years only. So does it mean don't invest in a mutual fund for 7-year period?
You are saying you want to invest only for a 7-year period. So when you invest for a lower period, history shows that there is a chance that your returns might be lower. There is a chance that your returns might be much higher. The risk is higher in a shorter period, and therefore the return is also, the likely return is also higher, but not the average return. So I think the way to reduce risk, if you are a person who wants to reduce risk, is do hybrid funds. I think 7 years is a fairly long period otherwise. What you can probably look at are good balanced funds. And among the balanced funds, please look at those that for the equity portion put it in large cap, and for the debt portion put it in short-term debt instruments.
Yeah, thanks, sir. Yeah.
Ankur has a question. Ankur, I have unmuted you. Please go ahead.
Hello, sir.
Hello.
I have a question that instead of going for mutual fund, I mean, this is all about mutual fund, but if I select couple of stocks, and then I keep investing it for long term, then how it will go?
Yeah, so what is your definition of long term, Ankur?
Let's say for 5 years, suppose I select couple of stocks, some banking, some IT sector, and some public sector. So if I just keep investing, rather than mutual fund, if I keep investing in those stocks, and after 5 years,
you plan to systematically invest in those stocks?
Yeah, let's say monthly, yeah, systematic. But I am not choosing any mutual fund. I am directly investing in the stocks. So after 5 years, what do you think how it will go?
So that's very difficult. That's almost an impossible question to answer, because the answer to that question is it will depend on the stock. You can do much better than the index, okay, or you may do worse than the index. Now again, statistics show that individual investors tend to do much worse than the index. That is what the statistics shows. But that does not mean that all investors make less money. But only a few investors will be able to perform better than the benchmark index. So suppose the stock that you are talking of is a large cap stock. Let us say you are talking of an HUL, Hindustan Unilever. Okay, the risk in a large cap stock is relatively lower. If you do systematically, again you are reducing risk. Now, will that beat investing in the Nifty? Difficult question to answer. But you're reducing the risk by investing systematically. So that is the only answer. But history shows that very few individual investors are able to pick stocks that can beat the index on a consistent basis. So I think that is the only answer that I can give.
Yeah, got it. Actually, I was, I mean, some like State Bank of India, Infosys and all, these are the large cap stocks, but the risk is lower as per my study, I mean, in higher and down markets.
So unless your full-time occupation is analyzing stocks, etc., I think it is good to leave it to professional managers who will manage it on your
Correct.
behalf. Also, it gives you diversification. So mutual funds have a large advantage. You're not this thing is not, your fortunes are not tied to a single stock. You're able to take a diversified position. There is a fund manager who's managing it. You can decide. So if you take a large cap stock, then you can decide that it will only go to large cap, etc. So, and it removes your biases. And if you are worried about the fund manager's bias, you can actually look at an index fund, something like a Nifty fund. That I think for most people, a mutual fund will make much more sense than directly investing in equities.
Yes, sir. Sir,
Benu has a question. I'm sorry, I cut off Ankur midway, but Benu has a question. Benu, I have unmuted you. You can ask the question. I'll get back to Ankur soon thereafter.
Hello?
Yes, Benu, go ahead.
I have a question that I suppose I cannot invest in SIP for the long term, say for 10 years period, but I have some lump sum to invest. So what do you suggest for me? Means it should hedge me against the volatility of the stock market, and my money also grows over a period of
time. So what period are you planning to invest for, Benu?
Say around 10 years.
If it is 10 years, then
10 years.
Sorry?
10 years.
If it is for 10 years, then you should invest through a systematic investment plan. That's fine.
No, but monthly putting the money will be difficult. But
okay, you have a lump sum available with you today. That's what
I
you
have
said.
a lump sum fund which I want to invest, and then forget it. Not I don't foresee giving month over month for that period.
Okay, so got that. So I think the danger of investing lump sum into an equity mutual fund even for a long period of 10 years is that there is a chance that your timing may go wrong. So what you could probably do is to put this money into a short-term debt fund and systematically transfer it into an equity over the next 24 months or so. And then you can hold that equity fund for the next 5-6 years and then slowly take it back to debt. Okay, let me ask some of the other FAQs that people normally ask. Does that mean I should not review my investment at all during this SIP period? Obviously not. Review is very important. You cannot not review. But I think what is more important is what should the review be on. You should always look at the relative performance. People come back and say my SIP is negative. Yes, your SIP may be returning negative, but how much is the benchmark? Obviously, if the benchmark index, if you are put it in a large cap fund and the Nifty is showing negative, there is very little chance that your own fund will not be negative. What you really need to see, this is a race. There is an anchor which is the benchmark index, so you have to make sure that your fund is ahead of the benchmark. And second, you have to make sure that your fund is in the top quartile of the racers. So I think what you really need to see is relative performance, relative to the benchmark and relative to other people in the same race. So if it's a large cap fund, you just need to make sure that your large cap fund is among the top quartile of all large cap funds and that they are beating the Nifty index or the Sensex, whichever one it follows. The other one I think was the question that probably Benu wanted to ask, what happens if my goal and downtrend coincides? I think this is a very valid thing. You had started investing earlier. Unfortunately, the downtrend came at the time when you wanted the money. So for that, I think very clear, just like you must plan your entry into a SIP, you must plan an exit from the SIP. You should, just like you should never enter into a mutual fund, equity mutual fund, one shot, you should avoid exiting a equity mutual fund one shot. So if your goal is 10 years, you must make sure that you start exiting that equity mutual fund after 8 years, let us say 2 years before your goal comes. What that essentially means is that at the end of 8 years, you should stop that SIP in the equity fund. Whatever is the balance, over 24 installments, transfer it to a short-term debt fund, and the SIP that you would have made in the 9th or the 10th year, make that into a short-term debt fund. And so this is called tapering off. You slowly taper off your investments. And if the period is longer, make sure that your tapering period is long too. So again, very quickly, should you bail out as your SIP is sinking? And I mean, that really you see these rats deserting a SIP. Only, as they say, only rats desert a sinking SIP. But if the alternative is the sea, the rats are jumping off into the sea, they are not going to survive. But that is in the lighter tone. I think clearly we have seen data shows that SIPs don't sink over the long term. As long as you have systematically made it over 10 years, history tells us that it has not sunk if your fund has performed well. And you can't, so you should not stop your SIP, but you can definitely switch your SIP. If your SIP is sinking more than the other funds, you can shift your SIP, but not really stop your SIP. Open to closing questions at this time. If you have any questions, I'd be happy to. Ankur has a question. Yes, Ankur, go ahead.
Sir, suppose if I go for mutual fund, then the question is, how would I select AMC? Which AMC I should go for? There are a couple of AMCs, so what do you suggest?
So I think before you go on to the AMC, you have to first decide what kind of assets you want to build. So how much money in equity, how much money in debt, okay? And for debt, there are options other than mutual funds as well. There is a PPF, which is an excellent option up to a certain limit, etc. Let us say we are talking of the amount of investment you want to make in equity. Again, I think you need to make sure that a significant portion of that money, what you want to allocate to equity, you need to make a core portfolio that's very large cap oriented. So that reduces your risk. It also reduces the rewards, because risk and rewards go together. But clearly, first thing is that you should have a core portfolio, about 50-60% of your equity portfolio, depending on the size, 50, 60, 70% should be in large cap. Avoid all kinds of sectoral, thematic funds. Stick to large cap for 50-60% of your equity investments. For the balance, you can look at a mid cap, you can look at balanced funds. That depends on what kind of portfolio you have. Once you have decided that, then I think comes what kind of schemes, and within those, so you obviously look at schemes that are in the top quartile. So if you say look at large caps, then there will be 3-4 large cap schemes. I mean, it can be an ICICI True Focus blue chip, it can be a Franklin India blue chip, it can be an HDFC equity, it can be a Birla Sun Life Frontline equity. Now these are the large cap schemes that are there. Among these, you might have a preference on a certain AMCs because you like the stability of their fund managers in those particular schemes, etc. So I think the hierarchy of choice is decide what you want to invest in. Make sure you don't put all your money into just one asset class like equity. Even within equity, you must put within large cap and some amounts in mid cap, small cap, smaller amounts in mid cap and small cap. Within large cap, if the amount is large, you can distribute it over 2 schemes, 3 schemes, depending on the amount. I don't know whether that answers your question or not.
Sir, you answers question. Thank you.
Okay. Vivek has a question. Go ahead, Vivek. Ask your question.
Sir, so basically what I wanted to understand is, so I'll just give my portfolio as an example. So I have selected HDFC top 200, IDFC Premier Equity, Birla,
Sorry,
Sunlight,
HDFC top
and
100.
Opportunity
HDFC top
as my
200. Sorry, what was the portfolio? I couldn't hear it.
HDFC top 200. HDFC
Okay.
top 200.
Go on. Hello.
Sir, can you hear me okay? Yeah. So so my question was, so when I selected sir, can you hear me okay?
Yeah, I can. Please go ahead.
Hello.
Yeah, please go ahead.
So my question was like, yeah. So when I selected HDFC top 200, the fund was performing better. But suddenly, I mean, if you see the returns of this fund, so that firm is not performing so well. So I just wanted to understand what is the right period to continue investment in such funds which are not performing, and when to exit from such funds.
Okay, so you raised a very extremely valid question, Vivek, and I think it is two things. You know, as the famous dialogue goes in that film Diwar, okay, ki lambi race ka ghoda hai. If you are investing for 10 years, right, a fund may do well in 1 year, may not do that well in the second year, etc. I think what you cannot aim to always be in the top fund at a given point of time. I think if your investment horizon is 10 years, if you want to invest in large cap, just make sure that the fund that you are investing is in the top quartile. That is the advice we give. And as long as your fund is in the top quartile of funds, don't worry so much that it's no longer the top fund by 1 year return, it's no longer the top fund by 3 year return. As long as it has beaten the benchmark and it is among the top quartile of the funds. Yeah. The other thing is, Vivek, you should, I think, again, you should have help from people who do research and will advise you on which funds to keep. And so there might be some funds that slip, but they slip just a little bit. So you might say that fresh investments don't do in this fund, fresh investment do in another fund, or it might slip so much that you might have to say even reduce the, even remove the investment that you have already made. So that really depends on research, etc. that you should take a decision. The fund that you have named, it has slipped a bit in terms of say a 1 year return. Definitely it has slipped. It hasn't slipped as much when you take 3 year returns. It hasn't slipped at all if you take 5 year SIP returns. Okay. So I would not be so quick to say that the fund hasn't performed that well. It depends on how you look at performance, and that's where Vivek, I think a professional person who can help you keep a track of where you are investing can come in useful. Okay, one last question we have time for. We have Amit who has raised this. Yes, Amit, go ahead.
Okay.
Go ahead, Amit.
Hello.
I think you are muted. You have muted your mic. Please unmute your mic. Amit, you have muted your mic.
Yeah. Are you getting me?
Yeah, I can hear you. Go ahead.
Hello.
Yes, go ahead, Amit.
Yeah, I'm investing from last 1 year, and after tracking that its record, I got to know that it's not performing well. So, is there anything kind of thing like that? How much time I shall invest in SIPs, and most of the SIPs are the large cap SIPs. So, shall I make some diversification?
You invested in which funds?
HDFC Growth Fund and Birla 95.
And for what period were you putting in? You have been investing systematically, right?
Yeah, from last 1 year and more.
Right. And for what period were you planning to continue?
No, I'm planning for the long term, means more than 10 into 15 years.
So I think the way to do this is, I mean, Birla 95 definitely is not a bad fund. Okay. HDFC Growth I am not aware of, so I cannot often tell you. But again, just like I told the other gentleman just now, Vivek, right? Don't take decisions based on 1 year performance. When you are going to be investing for 10 years, 15 years, maybe 1 year point-to-point return of a particular fund hasn't done well. Look at longer term performance.
Okay.
By longer term performance, for the category that Birla Sun Life 95 is in, which is a multi-cap category, it hasn't done too badly. It is among the top quartile. Okay. So, if multi-cap is what you wanted to get in, Birla Sun Life 95 is not something I would discontinue. I am not aware of the HDFC Growth, so I am not able to answer that question. But clearly, I think when you want to do a SIP of 10 years or 15 years, you should, Amit, take the help of people who can help you review, constantly review. At least once every quarter, you should review where the funds that you are investing in are placed. Are they in the top quartile or are they not in the top quartile? If you are interested, Apna Paisa would be very happy to do that for you.
Okay, thank you.
Okay, one last question now. Kapil, you have the floor. Please go ahead.
Yeah, sir, thank you so much for this lovely presentation today. And my question is that considering the drop of the rupee, sir, against the dollar,
right.
I started doing my SIP investments.
Right.
About one of the investment was SBI Emerging Fund,
right,
which I had started 6 months back as SIP.
Right.
But now today when I see it, it is showing about 14% drop.
Right.
Would it be a good idea at this time to switch to a fund which is US based and start an SIP? Should it be a part of our portfolio, a US based fund, which is India?
So I think you've got two separate questions, really. As I mentioned, the way you should think of your schemes is, and I'm assuming you are investing for the long term, right? I think allocate your monies first. That this much money I want to allocate to assets, to funds that will invest overseas. This much money. So SBI Emerging Fund appears to be a mid and small cap fund. I am not aware of the performance, but no mid cap and small cap fund has done well. You need to check what it has done with its benchmark and what your objective was. If that fund, and I think it's a new fund, it's definitely not covered by our research because or if it is covered, it is not in the top quartile because we look at funds that have completed at least 5 years. So I suggest that don't take such hasty allocation decisions. Allocation decisions don't go by the flavor of the season. When you take that allocation decision, decide upfront, okay, out of 100 rupees that I want to invest every month, 50-60 rupees I want to put in a large cap fund, 10-15 rupees I want to put in a mid cap or a small cap fund, 10-15 rupees I want to put in a foreign facing fund, 10% in a gold fund. Take the help of professionals if you want, and then stick to the category unless your requirement changes. Don't go by the flavor of the season. That is the advice that I would give you. So great. I think that is about all the time that we have right now. If you have any questions, please feel free to write to us. You can come on to our website apnapaisa.com. There is an ask a question stuff there that you can ask. You can come to our Facebook page as well. The Facebook page is www.facebook.com/apnapaisa. Thank you all. It was a real pleasure to have been part of this webinar. Thank you.